September 16th, 1992. A quiet Wednesday morning in London. But inside the world's financial markets, something historic was about to happen. By the end of the day, the British government would lose billions of pounds. The currency would collapse, and one man would make over $1 billion in a single trade. That man was George Soros, and the world would give him a nickname that still echoes today. The man who broke the Bank of England. But how did a hedge fund manager defeat one of the most powerful central banks on earth? To understand that, we have to go back 2 years earlier. You see, in 1990, the United Kingdom made a major financial decision. It joined the European Exchange Rate Mechanism, or ERM. The idea was simple. European countries agreed to keep their currencies stable relative to each other, especially against Germany's powerful currency, the Deutsche Mark. For Britain, this meant one thing. The British pound had to stay above a fixed exchange rate. But there was a problem. Britain's economy was weak. Inflation was rising. Unemployment was increasing. Yet the pound was being forced to stay artificially strong. To many traders, the currency looked overvalued. And one trader saw the opportunity before everyone else. Soros seized the crack. George Soros was already famous on Wall Street. But Soros wasn't just trading charts. He studied economics, politics, and human behavior. And when he looked at Britain's situation, he saw something dangerous. The system couldn't last. Britain would either have to raise interest rates massively or devalue the pound. Either way, the currency was going to fall. So Soros made one of the largest bets in financial history. Through his hedge fund, the Quantum Fund, he began short-selling the British pound. This meant borrowing pounds, selling them immediately, and planning to buy them back, later at a cheaper price. At first, the position was small, but his confidence in the pound weakened. Soros increased the trade, until the bet reached an incredible $10 billion. He was now betting against an entire country. Then came September 16th, 1992, the day markets would later call Black Wednesday. Currency traders around the world started selling the pound. The pressure was intense. To defend the currency, the Bank of England stepped in. First, they spent billions buying pounds in the market. Then they raised interest rates from 10% to 12%, then to 15% in one day. The goal was simple: make the pound more attractive. But the markets didn't believe them. Traders kept selling. Soros kept selling. And the Bank of England kept losing money. By evening, the British government had no choice. They surrendered. Britain withdrew from the ERM. The pound was allowed to float freely. And within weeks, the currency fell about 15% against the German mark and 25% against the US dollar. The cost to the British government? Around £3.3 billion in losses. But for Soros, it was the greatest trade of his life. His hedge fund made roughly $1 billion in profit. But here's the twist. George Soros didn't actually destroy the British economy. He simply exposed a weakness that already existed. The pound was overpriced, and the government was trying to defend something the market knew couldn't survive. Black Wednesday became one of the most famous events in financial history. A moment when the global market proved something powerful. Even governments, even central banks, cannot fight economic reality forever. And that's how one trader made $1 billion, by betting against the Bank of England.